Corporate finance practice problem using OneNote. Zero coupon rate bond price calculations. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, then down in the 1621 Zero Coupon Rate Bond Price Calculation tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations up top will be mirrored in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have the information up top, calculations on down below. We're going to be calculating bond prices again, but this time with the zero coupon bond rate. So once again, the bonds are something for normal bonds we focused in on in a prior section. So if you want to generally or focus in on general bond price calculations, you could take a look at that section where we focus in there, and we'll do the calculations possibly in a few different ways, including tables and possibly mathematical formulas as well as Excel formulas. If you want to look at the present value calculations in particular, take a look at a prior section where we focus in there and do the present value calculations multiple different ways. This time we're making a little deviation, that little deviation being that we have this zero coupon rate bonds. That should actually make it easier for us to do our calculations. So we're going to start off here. We got the bonds at the face amount of the 1,000. Zero coupon rate means there is no rate. There's no interest component to the bond price that we'll have to take into calculation. Then we're going to say that the issued to yield, in essence the market rate, is the 10%, and the years to maturity will be 15. We'll take a look at some variance on that, adjusting the issue to yield, or in essence market rate, down, and then we'll adjust it up just to see some differences in the variance, keeping the other two variables the same. So we'll start off with this first one where we have the face amount 1,000, zero coupon rate, and the market rate, or the issued to yield, the 10%, the years to maturity will be 15. When we calculate the price of the bond, usually there's two things we take into consideration. One is the present value of the interest payments, which we don't have this time because there's no coupon rate. So that's going to make it easier. That one will be zero. And then we take the present value of the principal, which would be the amount at the end. That'd be the face amount, the maturity amount. And that's where the present value calculation that will have to take place here for it. So in essence, this will be the calculation, this one present value type of calculation of the face amount or the maturity value. So the present value of the rate, in this case, would be 10%. The number of periods, which would be 15. And then we have comma, comma, because it's not an annuity, but present value of 1, present valuing that $1,000 back to the current point. That's going to give us the 239.39, 239.39, and that would basically be the answer there. Because once again, we're present valuing the endpoint. We don't have those interest payments. So the face amount of the bond, 1,000, zero coupon. We don't have the interest payments. Therefore, if we present value the 1,000 after the maturity date or the term of the bonds, the 15 years, at the market value or the issued to yield 10%, gives us the 239.39. Let's adjust that. Let's say the face amount still 1,000, but this time the issue to yield, or in essence the market price, 7%, years still 15. Once again, we don't have any coupon rate, so it's a zero coupon rate bond, so nothing on the interest side. We'll then do the present value of 1 calculation for the face amount of the bond, present value of the rate, which would be the 7%, comma, number of periods, which would be 15, comma, comma, future value, then the 1,000. Bringing that on back, we get to the 362.45. Now you can see as the rate goes down, we ended up with the value of the 239.39, and then the rate goes down and the price goes up to the 362.45. So we have that inverse relationship between the rate and price. If we took the rate, then up, going up to 14%. Same calculation, this time at the 14%. Once again, we'll be discounting then that 1,000 back because there's no interest component to it. So the interest component 0, there's no rate on the bond, it says zero coupon rate bond. So the present value of the principal then calculated as the present value of the rate, 14%, comma, number of periods, which would be 15 in this case, comma, because it's not an annuity present value of 1 at the 1,000, bringing it back to get to the value of the 140 10 cents, the 140 and 10 cents.